On today's show, Tesla hits all-time highs, inflation increases to 2.7% from 2.6% last month, the economic cycle explained, and what will stocks do for the next 2 weeks in December. We've got a lot to talk about. Let's roll the tape. Welcome everybody to the Daily Recap Show where we talk about stocks and the financial markets. My name is Chase. If you like this video, please subscribe, hit that notification bell as well as the like button and leave a comment for the algorithm. Let's get into it. This is the daily heat map of the S&P 500 and US stocks rallied on Wednesday, led by big tech as investors digested another month of inflation data that met economists' expectations and likely pointed to a Federal Reserve interest rate cut next week. And we really saw a continuation of what we saw this week. And for the month of December so far, the mega caps rallying, supported by a big move here in Nvidia, semiconductors, software as a whole. We saw Google, Meta outperform, Netflix participated, same with Tesla hitting an all-time high, Amazon up 2%, Microsoft up 1.26%, infrastructure participated, Apple down 0.14%, but they were up yesterday, so a bit of a give and take. Nonetheless, mega caps clearly led the rally. We did see some supportive action here from financials. PayPal up nearly 2% on the day. Very constructive price action in the mega caps, but not so much in the broader market. We saw most sectors actually lose today. You can see XLK, XLY, XLC. This is the Magnificent 7 sectors, all up in excess of 1.52%. Guys, a very, very bullish day today. When you see those 3 sectors up the way they are, you know the markets are going to do very, very well. The S&P 500 only up 0.85%, and that had to do with what we saw here. The broader market, these sectors actually did decline. Now, healthcare down 1.18%, just a bit of a dumpster fire. I think healthcare might actually be like negative or flat for the year after today's performance. And we really just saw like defensive sectors take it on the chin today. Look, healthcare, XLU, XLP, XLRE, the real estate sector, they all got dumped today in favor of cyclicals and cyclical growth. That's why we saw the Magnificent 7 names and the S&P 500 up in a very big way. And that was kind of the story here today. It was growth over value with blend in the middle, with large cap growth taking the cake today, up 1.77%. And again, led by some of those bigger names. But we also saw large cap core put in some very good figures here today, up 0.86%. Large value taking it on the chin, mid cap value taking it on the chin. But smalls posted a very, very solid day across the board. A good day for small cap value, core and growth, as well as mid cap growth, mid cap core. A very, very solid day today in the market. And to be honest, when you have growth rallying as well as the blend segment, the core parts of the market, you're really going to see the day you had today. And it was just a fantastic day. If you were in equities, cyclical equities, growth equities, you did very, very well, no matter what size segment. And part of the reason why we actually saw a rally today had to do with the CPI data. We got fresh inflation data which showed that inflation did actually rise on a year-over-year basis when compared to last month. We saw the previous month CPI came in at 2.6%. It actually came in at 2.7%. However, if you look at the consensus expectations, that is what economists actually expected. Headline and core came in at 0.3 month over month. That was the expectation. And then we saw the 3.3% and 2.7% in core and the headline figures. And that is why the markets were kind of bullish today. You had to look at sentiment going into this. I think markets came into today with fears of an upside surprise. Sentiment was not really good going into this print, and it was clear through the market price action this week. Did see a little bit of a defensive rotation on Monday and Tuesday, and we have seen a move into the large caps, the mega caps, and that's sort of like a flight to quality. Secondly, I think why the markets also rallied on the back of this had to do with shelter inflation. Shelter inflation has been the sole reason why the CPI numbers have actually remained sticky over the last several months. But in today's report, we actually saw shelter costs moderating Shelter inflation rose 0.3% versus 0.4% last month. Very, very constructive. The market has long awaited for shelter to moderate because of the lagged nature of the data points that the Fed use for their shelter components and their rent components. And this is actually a really good thing because it shows rate cuts are taking the pressure off homeowners and renters, and shelter inflation, which accounts for 40% of the total inflation, is actually moderating. So we should see this actually continue to move down, and that should help the inflation picture into 2025. That's part of the reason why markets have continued to rally in the last couple of months, despite the last 3-month annualized figure of inflation coming at 2.8%. So all in all, yes, we are seeing inflation tick up ever so slightly. As you can see, overall inflation right here, as well as the core components, we are seeing inflation tick up ever so slightly. However, shelter is continuing to moderate, and then we should see the overall moderation in shelter contribute to lower inflation figures into 2025, and that should take us to our 2% target, particularly in the overall inflation number. And as a result, the market's expectations for a rate cut next month actually jumped. Yesterday, we were expecting 88.9% of a rate cut here in next week's FOMC meeting. Now the market expects a 94.5% chance of a 25 basis point cut, and pretty much rate cuts are all but certain next week. As a result, the market was very, very bullish today. If we actually have a look at some of our market movers, leading the mega caps today was actually Tesla. It outperformed Google, up 4.5%. Now, along with all of the dynamics we saw, there was a lot of news behind this. The GM General Motors has actually halted its robo-taxi plans. As a result, Tesla's going to benefit immensely from this, just less competition. And Uber actually got hammered on the back of this news, down 5.45%. Uber looking very, very attractive. If we pull up a quick valuation metric here on Uber, definitely attractive. If we model this amount for 2024 revenue, that is the expectation coming into the fourth quarter, a 13% revenue growth to $80 billion in 2029, a 15% free cash flow margin. By the way, the street expects $85 billion in 2029 and $14 billion of free cash flow. So very conservative numbers. Then we actually use the EV to free cash flow model. The EV to free cash flow currently is 25 for Uber. We model a deceleration to 20 times. We get the enterprise value of this less than net debt. Look at their equity value. Then we actually divide by their shares outstanding, which should be 0. The management have stated that there shouldn't be any more share dilution in 2025 and beyond. A 2029 stock price of $124. That results in a 15% compounded annual growth rate over the next 5 years from the $61 mark where it is right now. So Uber looking very attractive, but that's on a valuation basis. And the truth is, sentiment right now, very, very sour, all things considered. And so this will probably go lower. I think we're going to see this name in the mid 50s. You really want to wait for this to consolidate before actually getting into this. Wait for consolidation, wait for some upside confirmation, then get into the name Uber. Nonetheless, we are seeing some sour sentiment in Uber, positive sentiment in Tesla. By the way, Tesla hit a new all-time high at $420 a share. Absolutely bullish price momentum. Who would have thought? Who would have had a new all-time high on their bingo cards with Tesla and Uber falling as a result? We also got the news from Macy's. At one point, they were down nearly 10% here on the day. They had a sharp rally, and that's because the company reported its official third quarter results upon the conclusion of an internal investigation into an employee hiding up to $151 million of expenses, and that led to a delay in reporting. Now, the stock did pare a lot of its losses, but still down 1.46% on the day. And when it comes to accounting irregularities, I don't want anything to do with it. Nonetheless, that did move the markets in its respective sector. And for everything we saw today, we actually did see the moving averages. The market actually did improve drastically from the 5-day, the shorter term moving averages, the medium and longer term moving averages all did improve significantly. Now, we did actually see a little bit of a deterioration here in the last couple of days, especially in the 5-day and 20-day. And here's a tweet that really explains it all. 117 stocks in the S&P 500 made a new monthly low yesterday, the most since 139 on Halloween. 211 made a 10-day low, the most since September 6. Not the end of the world stuff, but clearly some deterioration under the surface taking place. Now, I'm not saying that stocks are going to fall out of the sky, but there has been some clear deterioration if you look at the figures from last week to where we are right now, especially in the longer term and medium term averages. And from what we saw yesterday, now we did see a little bit of improvement in breadth, but I think part of the reason why we're actually seeing this is because we're seeing the mega caps rally, a very thin rally, and that's because we saw the broader market completely outperform in November. So we're just seeing a bit of a give back in December. We're seeing the mega caps rally going into 2025, and we're seeing a bit of consolidation in the broader market. That's how markets work, right? We can have a broad-based rally where mega caps rally 1 month, the broad market rallies 1 month, and that's exactly what we're seeing right now. All in all, stocks look very, very good. These are still very healthy trends across the board, and you don't really want to fight this trend. All you really want to do is take opportunity in the names you like, in the indices you like. And then looking globally, guys, we saw again very mixed action. China was red, but most of Asia was actually pretty green, except Australia. Europe was again mostly green, except for Germany and a couple of other countries. And then the Americas, super green. North America, Canada, the USA, as well as South America, very green. So an overall bullish day in the markets. Let's hop on the charts. Now, on the back of that inflation print, we actually did see yields rise ever so slightly across the spectrum. We also saw yields rise on the back of a bond auction that we saw. The Treasury sold $34 billion worth of 10-year bonds today, and then the dollar rose as a result. And despite what we saw in yields and the dollar, equities very bullish. The S&P 500 up 0.85%, the Nasdaq just shy of 2%, a very strong day. And then small caps, the IWM, actually equaling the S&P 500 in return. And you can see the broader market here, the RSP only up 0.1314%. Mid caps up 0.78%. So the broader market in large caps didn't do so well, but we saw the growth components of large caps outperform. We also saw small caps outperform and mid caps. So a very bullish day, if you ask me. I thought it was very good. And then we actually saw the metals rise as well. Gold up 0.91%. And that probably had to do with the fact that we're definitely getting that 25 basis point rate cut in December. Silver up 0.17% and crude up 2.62%. So all in all, a very positive day across the board. Whether you were in metals or equities, commodities or bonds, you did very well today. And the S&P 500 almost back to all-time highs. You see, this is what happens in positive gamma. The market just buys dips very, very quickly. That's what we saw. We actually saw a gap up right here and go. We're seeing a little bit of selling here at the highs, but that is a bullish candle. And we are going to finish in the top 1/3 near all-time highs. We'll probably go ahead and break these all-time highs in the days ahead. I think today's inflation report probably solidified the fact that the market has some legs to run into the end of the year. That was the big risk for the market. That risk is now behind us. We're going to get the rate cut. That's positive for the markets and onward and upward. And we probably go towards the core resistance in the S&P 500, which is at 61.32. So we go towards that level into the end of this week, into next week, into the FOMC. So onward and upward here for the S&P 500. Any dips we do get, buy those dips because we are in positive gamma, and you want to remain constructively bullish in a positive gamma environment. Now, the Nasdaq 100 saw some big moves. The gamma flip, core resistance, and put support all moved up in a very big way. 22,000 is now the core resistance. A huge move, a gap up and go. Virtually no selling at the highs here for the Nasdaq 100. And this actually has room to go to the upside. And you can see here that the market front ran us getting to the gamma flip, but we actually did put in a low right here, and we probably go target the 22,000 level in the Nasdaq 100. I really thought the RSP was going to outperform this week. That wasn't really the case. However, still a green day, and all in all, this is opportunity for you to get long in the RSP, because I do think we're going to see some outperformance from the broader market in the next couple of weeks into the end of the year. So if you miss the Nasdaq 100 train, as well as the S&P 500 moving higher, there is opportunity for you to get into the RSP as well as the RTY. You can see it's acting very good here right at the gamma flip zone. This is exactly what you want to see. We got into negative gamma. Bulls took us out of negative gamma. Now it's onward and upward to the core resistance. I think the RTY, the RSP should outperform over the next couple of weeks. Maybe we see a couple of days of consolidation into the end of the week. If you missed the rally here, guys, you should already be positioned. But if you're not, the RSP and the RTY is where you want to be. There's momentum in the Nasdaq 100, and that should go higher. as well as the S&P 500, and there's still room to run to the upside. We are in positive gamma across all of these indices. You don't really want to fight the trend. Individual names I like, guys. PayPal, strong name, up 2.44% today. Very, very strong move here today at the $90 mark. And look at this chart, guys. Look at the chart of PayPal. Literally higher highs, higher lows, and that's a new 52-week high at the 93 level. We're probably going to go and take that out into the end of the year. Another name I really like, I mean all of these names, by the way, Paycom, that's another 52-week high at the 240 level, up 2.10% today. If you're looking for a mega cap that's undervalued, Google up 5.27% today. This is where you want to be. My fair value for Google is about $220 right now. And that's an all-time high for Google. Absolutely crazy. Guys, I'm not in Uber, but I do like the name. I think you're really going to have to build out a position, and it's at a critical level, as you can see right here. It actually has broken that level, but you could probably move this down to like probably here, where it actually did touch this level right here. This level right here. So there probably is a little bit more downside for Uber before we start consolidating and going from there. Uber's going to have to really do something to revitalize sentiment nonetheless. I think this is an undervalued name, an underappreciated name, and I don't think robotaxis are going to have a material impact on revenue and earnings for at least the next 5 years. So if you're looking for value, great name, guys. The stock trades at 17 times FY26. That's cheaper than the market's multiple, cheaper than Google. So I really like Uber right now. And those are the names I like, guys. Uber, Google, PayPal, Paycom. I also do like Meta. Meta's a great name. I own Meta. That's another all-time high for Meta. Up what today? 2.38%. These are the names you want to play into the end of the year, guys, because we are about to continue this upward momentum. You think things can get crazy? Things are about to get more wild into December. We are about to enter the most bullish 2-week period ever of the year, and that's the last 2 weeks of December. So buckle up, be in the names you want to be. You want to be positioned, guys, because all you really want to do over the next 2 weeks is hold and let the money roll in. Buy the dip, don't trip. And if you're looking for alpha, you want to look at the RSP and the RTY right now, and you want to act quickly because these prices are not going to last, especially once we get towards the tail end of this week into next week. And let's talk about sentiment. The fear and greed index is sitting at the neutral zone right here at the 48 mark. Neutral sentiment is driving the US market, and that is actually a bullish sign, all things considered. And here's why. When the index is at a neutral zone, it often signals a market in transition. It shows that extreme emotions like fear or greed aren't dominating, meaning that the market isn't overheated or overly pessimistic. This balance creates an ideal setup for smart investors to step in and capitalize on opportunities. Historically, a neutral index is often preceded by upward momentum as confidence builds and as buyers slowly return. Oftentimes when we get into neutral sentiment, it's probably because we've been in the fear zone, moved up into neutral sentiment. That's a good thing. Or we've actually pulled back from highs and then we're looking to make the next move to the upside. If sentiment tilts towards greed, it could spark the next leg higher. And seasonally, the data tells us that is the case, because when the first part of the year is strong, greater than 10%, December is offered positive 80% of the time with an average return of about 3.2%. Very, very bullish. And you can doubt the seasonality if you want, but the industry is judged on a calendar basis and the laggards will play for a catch-up. And that's generally why we see December as such a seasonally strong period. We see a lot of investment recollateralization in the month of December for the new year, as well as buybacks and overall flows from the year prior. That all culminates in what we see as a very strong December. And when we go out and chart December seasonality, this is what it usually looks like. We see the first half tends to be structurally flat. We see upside, we see downside, but generally in a tight range. We then put in a bottom around the 14th, 15th, 16th of December. That's actually Monday, Tuesday next week. Once we put that bottom in, we then see a rocket ship higher into the end of the year for an average return of 1.5%. This is since 1950. 82% of the time we see December finish in the positive. And this momentum should continue into 2024 because strategists are very bullish. The average year-end price target for the S&P 500 sitting at 6,700 with 4 firms, Oppenheimer, Wells Fargo, Yardeni Research, and Deutsche Bank, all seeing price targets above 7,000. This represents anywhere from 13 to 17% upside from where we are right now. And the range of analyst estimates we're seeing right now is extremely tight between the 6,500 and 7,000 level. And this is one of the tightest consensus bands we've seen of any year on record. In fact, the last 2 years that have had such a tight consensus was 2017. And you could see here, this blue line is the S&P 500 price. And this right here is the consensus targets. You can see Bank of America, Credit Suisse, Goldman Sachs, Deutsche Bank always bullish. Oppenheimer tends to be the most bullish. And the S&P 500 in 2017 absolutely smashed the most bullish price target, finishing 2,600 with the most bullish price target being 2,500 and the lowest being 2,300. The other year we saw such a tight band of consensus estimates was 2008. Look at this tight range between 1,700 and 1,500. That was the target consensus. What did we see in 2008? We absolutely smashed the tight band. So if history is anything to go by, a tight consensus is usually wrong. It means we are either going to smash to the upside or smash to the downside. Either way, expect volatility. However, the macro environment is very favorable for us to actually go ahead and smash to the upside. You can see that according to BofA right here, we are currently in the recovery phase, which does favor stocks, and we are about to move into the boom phase, accompanied by a bear steepening. This does mean we see rates up, EPS up in this phase right here. Now, we do know that stocks with their brilliant balance sheets, especially mega cap stocks and US stocks, can handle higher rates. And if that is accompanied with higher earnings per share, we are going to see stocks go higher along with commodities. So do expect a boom in 2025. And small businesses are seeing much of the same. Small business optimism has absolutely rocketed up since the election in early November. The election result has signaled a major shift in economic policy, leading to a surge in optimism. Small business owners are very optimistic about tax cuts and deregulation, and that's why we're seeing small business optimism jump in a very big way. And the US economy remains in a very solid positioning, with new data released on Tuesday emphasizing the strength in the face of high interest rates. Productivity growth in the third quarter was left unrevised at a healthy 2.2% on a sequential basis, and the year-over-year rate remained unchanged at 2%, sitting just above the cycle average. That's exactly what you want to see, and the US is one of the only countries seeing very robust productivity growth. At the same time, the Johnson Red Book Index increased 4.2% for the week as reported yesterday. This was from the high of 7.2% we actually saw over the Cyber 5 sales. Now, the Johnson Red Book Index is a sales weighted of year-over-year same-store sales growth in a sample of large US general merchandise retailers, essentially a week-to-week version of retail sales, and 4.2% for this holiday season, looking very, very robust. And this is going to bode really, really well for consumer stocks, discretionary stocks, staple stocks, and it's a testament to the strong consumer we're seeing in America right now. All of this data right now, a strong consumer, productivity growth, and small business optimism probably does lead us to seeing a very robust holiday season and a consumer that's going to remain very resilient into 2025. I don't see deterioration in the markets right now, especially with the consumer. The macro looks good, and that should support stocks into 2025. And then looking at earnings, guys, tomorrow we just have two big names, Broadcom and Costco. They could bring relative volatility in their sector, particularly Broadcom. We know semiconductors are on thin ice right now, so if Broadcom actually misses earnings, it could be very bad news for tech and the broad market as a whole, because we do know the weight semiconductors has in the market. But if you've made it up until here, thank you so much for watching. If you liked this video, please subscribe, hit that notification bell, as well as the like button, and leave a comment for the algorithm. Cheers.